Good afternoon, everyone. Welcome to another Wednesday webinar. Frank was busy this week, so he won't be with us, but I'll be here, of course, and we're going to do the usual. We're going to go ahead and cover the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Russell 2000, and the Dow Jones. Once we're done with that, we will take some quick looks at gold, silver, oil, how the U.S. dollar is affecting them, and then we'll move on to chart requests. Those of you that are coming in now, if you have chart requests, feel free to put them in. Love to see what you guys are looking at. My name is stockdarts. You can find me at stockdarts on Twitter, stockdarts at YouTube, or patreon.com/stockdarts if you want to look at more of my trade ideas and more content from me just in general. I post on there 2, 3, 4 times a week and try to share more of the charts that I like to look at rather than just chart requests and stuff like that. So if you have any interest in that, feel free to swing on by and take a look over there. Other than that, let's go ahead and get started. All right, so here's a look at the S&P 500 and its SPY. Now, we have FOMC today, at least FOMC minutes, and that might just be what we need to have this market sort of take a breather and maybe start to explore down to the downside. Last week we were looking at the market and thinking, you know what, we're getting kind of stretched. We're starting to hit some key sort of resistance levels, some areas of supply, and we spent maybe 2 days sort of navigating through the 200-day moving average, and then we sort of spent this week just climbing even higher, right? And you can see, as we start to look at the market, you can see that it's starting to get pretty tired, right? A lot of the same things that we spoke of last week still apply. We still have mostly declining volume while the market sort of climbs higher. We're starting to see more of these little wicks at the top of the end of the candle showing that there is some selling pressure coming in. But for the moment, the sellers have yet to really be able to impact the price action, and that's really the one key thing we could say about the price action in 2019 so far is that the sellers have really had almost no impact whatsoever on the markets. Right? You go ahead and take a look, and again, we're past the midway point of February, and we could really just almost on one hand count the amount of red candles that have any kind of real significance. There's a couple of these dojis that maybe turn out red, but candles of real substance that are red. I mean, what do we got? We've got maybe 1, 2, 4, maybe if you count these sort of floating, these spinning tops. Not a lot, right? So for the most part, the buyers have been in complete control, and I don't think that they've really been tested yet. And that was something that we discussed way back in the beginning of January, or even in the middle of January, was what's going to happen when we finally test the bulls? Are they going to still sort of stand behind the stocks and continue to buy? And I think at this point the case has to be made that they almost certainly will, just because of how far we've gone past all the key support levels that would have been important tests of the market and where exactly the market is willing to buy. Now, again, we still haven't really had a strong test yet, so we'll see what happens. But I think at this point, the same thing that I've been saying for the last month or so is we should be looking at any sort of pullbacks now as buying opportunities. It's pretty clear that the market has changed character significantly from what we saw at the end of last year, and we've definitely found the bottom, at least for the short to intermediate term. Long term, I suspect that we will test the bottom again. I think at some point this year we'll test the bottom of the space. Whether we print new lows or not is really up to debate. But I think at this point, it's really a situation of where we go once we finally start getting a pullback. Are we going to continue to climb towards our highs from last year, or at some point are we going to shift to neutral and start trading sideways? Keith, you have an interesting question. Has there ever been a quadruple top? Yes. That's not really a pattern that you would mention, right? Some people say double tops, triple tops, but if you really think about it, a quadruple top is just going to be a channel that had 4 different instances where it tests the top, right? So, I mean, maybe not by that name, but there have certainly been plenty of channels over the course of any stock's history where it tested the top of that channel 4 times, right? So, for instance, you look at this right here, and again, I wouldn't call this a triple top because it's not a top, right? It's a channel in the middle it's a channel in the middle of all the price action. But you see, you had 3 tests, and then eventually it rolled over. No, but it also had 3 bottoms before it rolled over, right? But I'm sure that there's been somewhere along the line a channel at the top or a bottom of stock where it tested 3 or 4 times and then either bottomed out or topped out, right? So, yeah, I would say that I'm sure that that's existed. But if you're looking at this and saying, is this going to be a quadruple top with 1, 2, 3, and then 4? I would say that you're not really looking at it in the right manner. Because to me, when I look at reversal patterns or I look at patterns in general, I like to look at the price action in stages, right? And I think at this point, this test of 280 is to me a completely different test from these 3 times that it tested, right? In my mind, we've had 4 stages of price action that we could clearly see on this chart right now, or at least the time frame that I have outlined, right? We have the first stage, which was really started way back here, right? And that would be, let me get this rectangle, right? All right, and that would be this rising channel, right? That was one stage of price action. And then we had the drop, and we had this is what I would consider a completely different stage of price action. And that was where we broke down out of this channel, but we were still trading sideways, trying to hold at a certain level. And then we had the real big drop that occurred at the very end of the year that to me is a different sort of price behavior than what we saw from October to, say, the beginning of December. And then what we've done this year, right? Which to me right now is still the same thing. It's just one huge bounce off of those bottoms that we printed at the end of last year, right? So I consider this test of 280 to be completely different from this. So I wouldn't consider it a quadruple top or anything related at all to each other. I think that this is a completely different test. Now, again, it's still going to be the 4th time that we test 280 in the last maybe 2 quarters now. So it will be significant to see if we get past it. But I would hesitate to say that this is something like a quadruple top or something that I would lump in together as the same price action. I think we've changed significantly in environment from the last time we were there to what we're doing right now. So I would consider that different. Again, under the assumption that that's what you're referring to when you bring up the idea of a quadruple top. And again, I wouldn't call this a quadruple top anyway because we're not at the top, right? It's 4 times that we're testing an area, but is this a reversal pattern? It's hard to say, right? Because the last time we were in this channel, it was actually a continuation pattern off of the top that we experienced up here, which you could say maybe was a double top or something along those lines. And so it's hard to really gauge exactly what we want to call these things. But the important thing really is to sort of gauge, like I said, rather than to find the name for it, is to understand what's going on. And like I said, I like to look at this as this is a completely different test because of what we've seen throughout the last, I guess, 7 or 8 months now, right? And I think, again, that this is a totally different type of test than what we had in the last 3 months of last year. Now, that being said, I still think this is a strong level of resistance, and ultimately I don't expect us to push past this level. Now, I could be wrong, right? And the reason I could be wrong is because, well, the market hasn't stopped moving. And it can often surprise traders, and if every trader expects this level at 280 to hold, then more likely than not, the S&P 500 is going to just sort of push right through it, because that's what the market always does. It's always going to go the path of least resistance, and if everyone is expecting that to be the resistance point, then the market's just going to kind of fool them and continue pushing past it. Now, ultimately, I think even if it does push past it, it will eventually roll right back through there, because again, I think it's a critical spot here, and we have yet to really be tested. And I just don't think that we're ready to start testing the new highs and start pushing towards the highs that we had last year. Now, this, of course, is just my opinion, and my opinion has really no bearing whatsoever on what the market's going to do. But my thought process is that we've sort of pushed past the 200-day moving average, but we still need to kind of really confirm that we're ready to stay above the 200-pair moving average. If you notice, again, the last 3 times we tested it, we did go through it, but then we eventually rolled right back underneath it before we really started to cave to the pressure and really drop strongly into December, right? And so the fact that we've gotten back above that moving average is nice, but I wouldn't say that that means we're definitively over it. I still think that overall we are more than anything just back into trade in the same range that we spent most of last year in, right? This base that we formed between about 290 and about 260, right? And we're right in the middle of it. Ultimately, we'll probably test the top and the bottom of this at some point in the next 3-4 months. And the question now is, really, how do we behave once we're in here? But I think that we're fine in here. And I wouldn't be surprised if we did something like this. Let's move this back to solid lines. And then maybe came right back up and then started to test the highs. And I think that would be, I could get behind something like this, where we'd come up like this and then maybe test 280 again and then make our move to 290. But to just sort of continue like this, while it can happen, it's not what I want to see. One, because I think that would lead to an even sharper drop once we finally do drop. And more importantly, this would not really give us good risk reward. Those of you that are Patreon subscribers and looked at my trade idea from yesterday, you'll notice that one of the things I mentioned was that this market it's kind of a paradox in that we're in a very strong market, but it's not a great market for trading because it's not giving traders very good opportunities to the long side because the risk reward's just not there. The first few times we had nice little bull flags, right? We had a nice little bull flag here. We had a nice bull flag there. We had a nice sort of bull flag there, but now it's really just starting to drift higher and higher without really giving traders any kind of continuation patterns, any kind of nice little consolidation ranges that give you a chance to get better risk reward and to let the momentum sort of rebuild when you have buyers sort of getting rid of their shares and you have new buyers stepping in at nice value areas that have confidence to let it go higher. What we have now is just traders chasing price action, which is usually a recipe for an eventual downfall. And because of that, it's become increasingly difficult to find good setups because what do you have left? Either you buy something that's near resistance or you buy something that hasn't moved yet. And if you buy something that hasn't moved yet, well, think about it. That's a stock that hasn't moved during a market that really has just gone straight up, right? So I kind of made the analogy, it's like buying something on the clearance rack. I mean, it's on clearance for a reason, right? Nobody has wanted it up to this point. And you're basically just buying it in the hopes that it's going to sell like everything else that has sold so far. So it really has been a little bit trickier, especially over the last couple of weeks. And I think at this point, we should be looking for a drop, right? And if you are confident in your price reading skills, then you're hoping that we get a drop and you'll understand where the levels of support are, where you can go ahead and turn around and re-enter to the long side, right? And I think what happens a lot of times is at this point, traders are like, oh man, I wish we could get a pullback. And then when we get the pullback, they get a little scared and they're like, oh man, but I don't want to buy it now. It's been dropping for 3 or 4 days, right? So what we have to do now is understand where are the levels of support that we'd want to buy at and what are the confirmation signals that tell us that we found support at those levels, right? So on the S&P 500, I would say that we can look at our previous level, this previous bull flag here, right? So ideally, this would be the first area where we could buy a pullback, right? It'd be right to the 20-period moving average, right around 271 to 270, and that'd be a nice spot to go ahead and buy a quick dip. And if that were the case, you can see we'd maintain this sort of trajectory, right? And that'd be a spot where you could look at buying the dip. Ultimately, another key area that we could end up buying is an extension of this previous support zone right around 263. And I think ultimately this would be the spot that I'd get really comfortable buying because to me that would be enough of a pullback to really sort of shake out a lot of the weak hands that have been chasing the price action higher. It'd be a good value, a good area of value where I think a lot of buyers have been waiting to step in. Be the bottom of that channel, which I think is kind of significant. And ultimately would be the spot that I think would give us a really good risk reward setup in order to push right back up to 280 and then hopefully beyond and give us a really good potential for a long sort of gain. If we fell below there and started testing 258, then that's why I'd start to get a little bit nervous, especially if we fell below 258. I think if we fell below 258, there'd be problems. But again, with the strength that I'm seeing out of the market, I don't anticipate that at all. I don't even know that we're going to get to 263. That's just the area that I'd love to get to. The first drop might just get to the 200 period moving average, and then maybe form another bull flag, and then another test of 280. So we don't really understand the shape that this will take when it eventually pulls back, but we can sort of set up different scenarios that could work out, right? So first stage would be, of course, this rising trend line, the 200 period moving average. That would sort of work, but it would really just be more of the same, which would give us a 2 or 3 day run before we really have to worry about the level of resistance again. The next stage again would be below there and somewhere down here around 270, and then ultimately around 265 if we did have maybe a multi-stage drop. And I think anything below there, then you start to get nervous. But as long as it stays above there, I think I'd be perfectly fine with taking pretty risky attempts at playing long plays because the market is definitely going up again, and we want to go ahead and take advantage of momentum in that direction rather than trying to get cute with shorts or kind of getting scared of playing to the long side. Now, levels above us, in case this market continues to squeeze higher, well, if we get above 280, then the next real strong level is 286, and that's actually a pretty good distance away. So there's still plenty of opportunity for this to run higher. But I think if we start to get to that territory, it starts to lead towards the chance of an even swifter drop. And I really wouldn't want to be chasing price action up into that level because you start to get less and less potential reward out of a move and a lot more potential downside. And so one of the key things that I always teach whenever I'm mentoring traders or teaching them, or whenever Frank and I have workshops, is just because a stock goes up doesn't mean that it's a good buy, right? Or a good trade anyway. If you trade something and you break all the rules in the book and it goes up, you didn't have a good trade. You just got lucky. Or, you made money on the trade, but that doesn't mean that it was a good trade. And ultimately, if you do that trade 10, 15, 20, 100 times, you're going to lose more often than you win. And you really have to embrace that when you're trading, right? Even though there's a chance that this continues to go from 280 to 290, buying right now, at least as far as the S&P 500 is concerned, it's not a good idea. There are other stocks that maybe are set up and they're closer to value areas and they give you better risk reward, and those might be worth trading. And I think in this kind of market, there's always stocks that you could find, even if they're at a discount and there's a reason for the discount. There are stocks that give you better setups. But as far as looking at the S&P 500 and any chart that is along the same sort of price pattern or behavior here, you don't want to be buying right now into all these resistance levels. You want to be buying when you have more sort of thoroughly formed levels of or phases of consolidation that give you better risk reward and give you better opportunities as far as the timing is concerned. And I think right now, timing wise, we're just not in a good spot to go ahead and go long too much. So for the most part, I'm sitting on my hands. I'm still finding a few sporadic trades here and there that I like, but ultimately I think we will have a lot more trading opportunities once we get a pullback. And like I said, today's an FOMC day. Maybe they hint at raising rates at some point now that the markets sort of climb right back up, and maybe that scares traders enough to finally get some red candles here, and we get a sort of a reset where we could find some better value buying opportunities where we could buy at closer areas closer to support that'll help us get better potential moves for profit taking. Now, if we look at the NASDAQ, it's very similar to the S&P 500 in that it's sort of getting above the 200 period moving average. You can see we did a really good job of breaking that descending channel. Now, interestingly enough, the Qs have been sort of falling behind a bit as far as relative strength is concerned. The S&P 500 is quite a bit closer to some higher potential areas, while the Qs are still sort of struggling. I would say this 178 to 180 level might be one of the key points that it needs to get to before it starts to make its way up towards the highs. So there is more room for this to kind of drift higher, but you can also see we've got a nice little wedge here forming, which again typically is a pattern that you'd find once the market's ready to roll over, right? And I think that this is another one that you can see a lot of times if you're trading equity and you have a break of a channel, you have a nice run up. Eventually, you come back and retest that breakout, and then that's when you get the real strong move to the upside. So this is another level. We're looking at potential price patterns here, right? How we'd want to go ahead and trade. I think ultimately, if we get a drop from the Qs and we come back and we test the 20, maybe a little bit below, and start testing this 166 to 165 area, that becomes a good spot to look at potentially buying the dip. Now, there's always the chance that this continues to chop and drop, head down a little bit more south, but if that's the case, we still have a clear stop out area, and then we would just go ahead and re-enter if it came down to the next stage, which would be around 161, which would be the 50-period moving average. Now, I think with the Qs, it's a little bit more clear-cut than the S&P 500. With the S&P 500, all of these levels look fine, right? Whether we buy here at 275, whether we buy 270, or whether we come all the way down to 263, it all still looks like we're just testing previous level of support. Now with the Qs, it's a little bit different, because if we lose this level here, then it feels like we're back inside this channel, right? But ultimately, I don't think that's really that bad, because the truth of the matter is that because the Qs were so strong when they were dropping, this channel takes on a different form altogether. The S&P 500, that same channel, really the bottom of the channel was here at 263. So we really haven't left the channel on the S&P 500 while we have on the Qs, right? So it's interesting because we have a sign of potential relative weakness on the NASDAQ as far as very short-term price action is concerned. But in the intermediate to longer term, it still has relative strength because it was so strong during this time. And it formed a different sort of pattern. Actually, sorry, because it was weaker during November to December, its channel was in a different spot, and because of that, it sort of climbed back and was able to sort of regain it faster this year, and now it's starting to slow down once it has gained it, right? And so I think ultimately with the Qs, I don't really want to see it drop below 165. I think if we do, then there's still potential for it to bounce. There's a nice key support area right here around 160. And anything below that, I'd start to get nervous. If we start heading back to 156, then I would say maybe it's time to readjust our stance and try to figure out whether the market has sort of changed character again. Fernie, you have a question. That would be random result as opposed to having an edge. Well, you were talking before when I was mentioning about whether just because a trade goes up, it's not necessarily a good trade. And I agree 100% with you. There's a certain level of randomness in all of our trades, and as a trader, we have to sort of embrace that and realize that you can take a good trade, but that doesn't mean that the trade's going to succeed and make you money, right? And ultimately, you have to look at it as a set of probabilities, and realize that if you take a certain trade a certain amount of times, over the long run, it will work maybe 60% of the time, maybe 55% of the time. And we make our money based off of those probabilities. Some trades only work 30% of the time, but they return 5-to-1 risk versus reward, and that means that it's worthwhile to take that trade, even though you're going to fail 7 out of 10. And that's fine as long as you understand what your expectancy is for that sort of trade process. But yes, that's a very good point, in that there is a certain amount of randomness, and that's why we have to be so careful about the trades we take, is because we know that even if we take a good trade, it could not work in our favor multiple times, even though we're taking good trades. James, we'll take a look at CLR for sure once we get through this. Now, again, so for the Qs, we pointed out the key support levels that we would hope can hold, right? And I think ideally for the NASDAQ, I would like to see a move down to 166 and no further really than 166 to 165. If we do, this area around 160 can be okay, but at that point, it's already been a little bit more substantial drop than maybe we were looking for. And that would be analogous to the S&P 500 maybe coming back and testing the bottom of its previous channel. As far as upside is concerned, I think the NASDAQ has slowed down quite a bit, and I would not expect price action to get above 178 without any sort of real pullback. And if we had a strong move, if for whatever reason we're very happy with FOMC and we start to shoot out of a cannon, then I expect 178 to be the point that we reach before we sort of stall out, which is, I mean, that's still 7 or 8 points of upside. But it would be difficult to get behind trying to play that to the long side, especially when you look at this rising wedge and what's really going on here. Again, a rising wedge on declining volume typically hints at a sharper pullback coming in the near future, right? So I think that there's a higher probability chance that we test 166 first before testing 178. But again, FOMC is a wild card, and who knows what happens as we react to that. But ultimately, I expect us to probably come down and test some of these lower areas. But I expected that last week, and so far we haven't seen it. So we'll see what ends up happening. Now, let me move this back a bit. And let's take a look at the Dow Jones. Now, the Dow Jones has started to show some relative strength again and has been sort of the leader in climbing higher, and really has already tested, or is reaching kind of that key area that I don't expect any of the other indices to get above. Well, the Dow Jones is already there. Now, there's a couple of ways of looking at the Dow Jones, right? We can say that it broke this already a while ago, this descending. It sort of had the bottom was a horizontal level of support, but the top was sort of a descending trend line. And we sort of already broke through that. We spent this week sort of moving past it and are testing a really key area here, which is this 260. Now, because of the way that this sort of set up, there's not one clear zone, right? It's between 260 to about 263. And I think 263 ultimately is the really key level to get past. You can see that's where volume really sort of stepped in, and volatility. But it's already broken through some pretty key areas, and that's kind of important because it's showing again that the market has really put this in the rearview mirror. This big drop that we had at the end of last year, and has really started to make its way higher. Now again, volume's still declining while we're going up, and you can make the case that these kind of patterns, these really thin sort of climbs these are usually not very sustainable. And ultimately, I expect us to pull back. But the way that the Dow Jones has sort of set this up, very similar to the NASDAQ, we can look at this as being sort of a quick pullback back to its previous area. And then you've got the 200 moving average already starting to climb up. You've got the 20 sharply trading higher. You got the 50 starting to move. So I could see something like this where we just pull back into this 253, 252, 251 area, and then set up for a bounce back up into 260. And I think, again, that would be the ideal scenario. We just get a nice pullback, nothing too steep, nothing too worrisome. We get a nice little bounce, and then we have a continuation back to test previous highs. If we start to really test it, we can come all the way down to the 200-period moving average. And I don't think that we should get past that unless the FOMC news is really, really bad. And ultimately, as long as we're above 243, I think we're safe. But like the NASDAQ, I think because of the nature of this descending channel, we probably want to stay above there or very close to there on our first test. We don't really want to slice through there. And I don't expect us to with the amount of strength that has really sort of started to really affect the markets. And I think ultimately we probably just test. We get one test into this level, then trade up. And then we decide whether we need to test lower. And again, I think that we have to look at this as sort of a process that's going to play out over the next couple of months, probably up to the next earnings season, where we are going to come down and test and then make our way higher. I don't think we're ready to push to new highs, so we need to sort of spend some time trading in this area here, right, between maybe the 240s all the way up to the mid 260s, and just sort of backtrack and retest and really fill out some of this area that we really made a move past. Greg, you have a 1 hour look at the ES. Let me see what I'm not sure I could pull this up, but let's see. So this is what you're looking at, Greg, which is going to be very similar to what we're seeing on the S&P 500, right? And so you're looking at these key levels of support, and it's going to be pretty similar to what we're seeing on the S&P 500. We go to an hourly chart, and so these were the three levels you were looking at in this area as we formed this little spot here where we had a nice level here, a nice level here, and then we made our way higher. And that's going to be very similar to what you have. And then right where we are right now is, again, really just sort of testing that level around 280, which is really coming up into a key area, right? So I think what you're seeing on the ES is almost, I mean, it's going to be the same as the S&P 500. And really, it's, I try to stay to the daily charts on the Wednesday webinar rather than looking at the hourly, like day trading charts. But yeah, I think that we're at a spot here where we're just really trying to establish some price action above the negative trends that we had developed in October and November. And as you can see, the Dow Jones has already done that, right? And I think that's, again, it's a real positive to take. But ultimately, I think that we're starting to get a bit ahead of ourselves, where there's only so much more room to the upside that we can really take without sort of retesting some of these areas. One of the things I always point out also when I'm teaching traders is this idea of that the market goes through two types of moves, right? You have an action, and then you have a reaction to that, right? So, you have the buying or the markup, markdown, and then you have the consolidation ranges, which can be looked at as distribution or accumulation. And right now we've had a massive markup stage, right? And we haven't really had a reaction to that yet. We haven't had a consolidation base. We haven't had this wide area that we could consider a potential area of distribution or even a potential area of developing supply as we set up a staging area for the next move up. No, we've just been straight up with these really minor reactions that are part of just this overall action higher, right? And ultimately, we need to react to this. We need to find the consolidation range that comes after this, and that could be a pattern that plays out over the course of the next month, or it could be something that plays out all the way into summer, where we just sort of base out and trade sideways and really start to set up either a move up here in this upper half of the range, or just sort of establishing price action below the bottom of that range, right? But as you can see, what we've done right now is very impressive, and now it's just a matter of are we going to spend the next month just really, really probing the upper levels, or are we going to spend it somewhere in this area, trying to just make sure that we establish that price action is done with the bottom of that channel and wants to just sort of make its way higher, but in a more patient manner where it backtracks, improves, that there are enough buyers to support this level once it comes back and gets retested. And again, I think that's the one point that I've been trying to make over the last month and a half now is that the buyers have not been tested yet, and I really want to see what happens when they finally get tested. Because of how strong it's been, I assume that they're going to pass the test, and they're going to support the market at the levels it's supposed to be supported at, but we still need to see that happen before I could really get behind the idea of retesting and pushing to new highs. That would be very, very impressive considering what we saw over the last year. And again, I think ultimately, really, we're just trading sideways. So I don't think that we're really ready to push past the new highs. I think we still need to sort of test these levels. Now, that doesn't mean that I don't think we're still in a buyer's market. I still think that we are in a market that's moving higher. But ultimately, I think it needs to spend more time trading sideways. And what we should do is just make sure that we are on top of these fluctuations and taking advantage of the support areas once we come back to them. Now, finally, we have the small caps. And the small caps, over the last couple of weeks, have actually been pretty strong. And they have been doing a good job of playing a little bit of catch-up with some of the other indices we just covered, which have ultimately been stronger than them over the course of the last few years, actually. And I like what I'm seeing here. We broke another descending channel, and ultimately, very much like the NASDAQ and the Dow Jones, if we falter here to 200 and come back, it'd be nice if we just test this breakout of this descending trend line and then go ahead and set up for a bounce, right? I think that would be pretty nice. If we fall below that trend line, I don't think it's that big of a deal because, again, it's really indicative of a different phase of the market than where we are right now. So if we lose that level, it wouldn't be the worst case scenario. I think as long as we stay above this little bull flag, we're in pretty good shape. That'd be the 20-pair moving average as it kind of comes up to meet price, and that'd be fine. Ultimately, as long as we're above 145, we're actually fine. So even if we lose this level, it's not the end of the world. But I wouldn't want to see it because if we lost that level, it's a very good chance that we're going to push down and probably through 145 as well. And I really 145 is the key point. Like if you're still not sure, you still don't trust this market, and you still have one foot out the door, then keep an eye on IWM and what happens. If it starts to threaten 145, there's a pretty good chance that that means that the market is starting to get scared again, and ultimately probably we'll see some more selling on the other indices as well. But for now, if it starts to lose 153, it's not the end of the world. But it'd be nice to find some support down here around 153 to 151. And then from there, if that's a good support area and we make our way back up, then I think that ultimately that shows that the market is ready to move higher, because it will have retested a nice breakout and successfully been able to move past that. And I think that's really what we're looking for whenever we're trying to make these trades. Is sometimes you don't take the initial breakout trade, but once the market establishes that it's done with a range, then that previous level of resistance is, obviously the cliche is the previous levels of resistance become support, but it's a cliche for a reason. It's because it's ultimately one of the easiest types of trades you can make, and it's more than anything, it indicates that the market has sort of moved on through a level, which makes it much easier for you to go ahead and take confidence in trading through those levels. And so that's what we're looking for right now, really across the board. I think the S&P 500 is the only one that hasn't really made a clear, doesn't really have a clear level that it's broken through, because it still needs to break through 280. But you can see the NASDAQ broke through a key level, and as long as the retest keeps it above that, we're fine. The Dow Jones also broke through a clear level, and as long as the retest stays above there, I think that's really bullish. And the same thing with IWM. So we've got three of the indices that have broken through a sort of a descending trend line, and as long as the pullback stays above there, I think that's a very, very bullish play. Now, if we fall back below that, that doesn't mean we still don't have a good buy the dip opportunity. It'll just be a little bit more difficult to trust. But I think that there's still potential if you just look at the previous levels of support that I pointed out across the board. So that's the four major markets. Again, I think that we're reaching a point where it's hard to trust this to the long side until we get a pullback. And so that's why I spend a good portion of today looking at potential pullbacks and where we go if we do pull back. If we continue to squeeze higher, there's not much you could do other than find trades that are beginning to follow or beginning to sort of play catch up, and play those, because at least those give you good risk reward. You don't really want to chase the action with names that are already stretched out and are near resistance, because you're just putting yourself in a position where ultimately you'll probably get punished for that sort of play, whether it's on this trade or the next trade. So make sure that you understand what your rules of engagement are for accepting and entering trades, and make sure that you honor them and you don't start getting a little aggressive. We mentioned last week that there's two types of fears in the market, right? There's a fear of loss and there's a fear of missing out. And more often than not, it's the fear of missing out that really puts traders in a bad situation, because they get antsy and they get impatient and they start taking bad trades because they feel like the market's leaving them behind. And the truth of the matter is that the market is always fluctuating back and forth, and you're always going to get an opportunity to sort of re-enter, whether you have to wait a week or you have to wait a month. Sooner or later, you do get an entry into these names, and you just have to make sure you take advantage of the opportunities when you get them, and not let the market sort of dictate how you enter a trade. I think that's usually a point of the potential disaster for a trader. All right, so Ron, you have a very good question. Is Bollinger Band expansion something you guys watch for in swings? I don't. I used to. My brother, who was a very good trader in his own right, there was a point there where he traded a lot off of Bollinger Bands, and he got me looking into them and playing with them. And what I found was that for me in particular, a lot of times when the Bollinger Bands expanded, I felt like the move already happened, and it was very hard for me to really gauge what was going on. It's actually very, very similar to a question that we had last week about, do I follow unusual options activity? And I had the same issue with the Bollinger Bands that I do with the unusual options activity, which is you almost have to do the opposite, right? You have to play the narrowing of the Bollinger Bands, because once they expand, you've already had the move. That's why the Bollinger Bands are expanding, right? And it becomes a lot more difficult. At least I didn't find a good way of working off of them. And ultimately, I found that for me, what worked best was trend lines. But every trader goes through a stage where they're trying to find themselves and they're trying to find what works for them and what doesn't work for them. And I think Bollinger Bands are a very good tool. I think that they do a good job of measuring a very real and important phenomenon in the market, which is how much a stock typically moves, right? Through standard deviations, whether you want to use average true range or you want to use standard deviations. Sometimes understanding just what kind of volatility a stock is capable of when it's trading below that level, when it's trading above that level. I think those are very important things to keep in mind. But, and like Keith mentions, all indicators are lagging, and that's one of the issues that I found was that a lot of times by the time that the Bollinger Bands expanded, it was too late for the move to really happen. At that point, it was almost like I was looking for the opposite. I was already looking for when they would contract. Now, that doesn't mean they can't work. I think that they still work very well. They just work for certain types of trading. And what I found for me was that I found that the trend lines gave me the best view of when volatility was contracting and when it was going to change, right? So when you get a nice triangle pattern developing, or when you get a nice little flag, like say for instance this, just for lack of not really want to sift through charts for better examples, to me, what I found worked best for me, better than Bollinger Bands anyway, was when I found two trend lines converging. It gives me a very obvious trade. I know exactly when it's going to expand. I know exactly when volatility is going to start expanding through there, and it's a lot easier for me to read than going off of Bollinger's. But that's not to say anything disparaging about Bollinger Bands. I think that they work very well, and I think that there's a good. I think they actually work very well for traders that sell options, and that's one of the key areas where they actually, I think, maybe offer more than possibly even like trend lines or other types of indicators. Is they give you a good idea of when a stock is reaching a statistically improbable movement, right? And that's not to say that the stocks can't continue to move through those levels, but it gives you an edge where you know that more often than not, it's reached the point where it probably needs to start to stall out and sort of revert back to the mean. So it's a long answer for me just saying no, I don't use Bollinger Band expansion. It's not something I trade. It's not something Frank trades, but it is something that I did experiment with in the past. And I think ultimately the most value I had out of Bollinger Bands was selling volatility on premiums, right? Selling put spreads, selling, taking credit iron condors, and playing off of that. And ultimately I did play with that for quite a bit before I moved towards just using those condors during earnings. But I think that they're a very valid instrument for the trader that finds a use for them. I found that I had other things that helped me more. Not to say they didn't work for me. I found stuff that I liked better, if that makes sense. Okay. All right. So again, I think that the stock market has reached a point where I'd rather see a pullback than continued action higher, and that's what I'm waiting for. Now, interestingly enough, we have kind of a weird move or setup happening here with the U.S. dollar and oil, gold, and silver. The U.S. dollar, it's pulled back the last 3 or 4 days, right? So that explains the massive spike that we saw in GLD and SLV. But ultimately, also, what we're still seeing that's kind of weird is the U.S. dollar is actually still behaving in a sort of a bullish stance, right? And we pointed that out last week, that even though it was probably due for a short-term drop, if you look at what's happened, we broke that trend line, which was negative, right? And we spent some time sort of looking like we were ready to roll over, but then we broke past this 25.60 area and came up, retested the trend line. Now we're back. Now we're at a spot where the U.S. dollar probably wants to try to stabilize and find a bounce. If it doesn't and it drops, well then it's par for the course, and it's going to be similar to what we've seen recently. And obviously with today's FOMC, we're going to find out very quickly if we find support at this level or whether we come back down to the bottom of this channel. And I think that's going to have a big impact on gold and silver. But the thing that I wanted to point out that's a little odd is that even while the U.S. dollar was sort of setting up for a move higher, GLD and SLV were also setting up for a move higher, which actually worked out very well. And they actually busted out very, very strongly. I think much stronger than I anticipated. I knew that they were setting up nice bull flags. But because of the strength I saw in the U.S. dollar, I wanted to make sure that I saw the U.S. dollar pull back before I would sort of re-enter the long plays that we had on GLD and SLV. And that ultimately did prove out to be the case, but I actually did miss these bounces because I wasn't looking at them at that point. And we had a very strong move, and this was across the board. There was a lot of these gold stocks that I've been pointing out worked out really good. It's not Kim. Here we go. You can see KGC, which is one of the ones I've been trading back and forth, had a huge move. I mean, this is a big percentage move from 320 to 380. And so the question now becomes, is the U.S. dollar going to bounce, and are these things going to fade, or are they all going to rally together? Like, what exactly is going to happen? And I think we're going to get I think we'll get much more clarity based off of the FOMC minutes and what the Fed's tone is as far as new rates going up or not going up, and that'll tell us whether the U.S. dollar is going to continue sort of pulling back. And if that's the case, then I think that these things can continue moving forward. Now, that being said, I think gold and silver have reached the point where they probably need to set up a flag here, right? They've already, I mean, sort of, when you have these three breakaway gaps like this, that's pretty hard to sustain. But we'll see, again, what happens with the U.S. dollar. Now, if we look at some of the euro or the U.S. dollar crosses, we'll look at the euro first. And again, you'll see that the U.S. dollar actually made pretty good headway versus the euro. Despite what we just saw in UUP and despite what we saw in gold and silver, the U.S. dollar actually had gained pretty good strength against the euro until the last 2 or 3 days. And I think is really sort of forcing the issue here with this key level that we've been watching now for a while, which is this 113 area. And you can see, again, we've had a lot of false breaks back and forth through there, but price is really starting to push down and really start to really threaten to break down below here. And I think ultimately this is going to be the key to what we see on UUP and what we see on the U.S. dollars. What happens at this point, right? We've got all these, and I keep drawing all these trend lines because there's so much back and forth here. But ultimately, the U.S. dollar and the euro are going to have to they're going to have to resolve their issues here, and we're either going to get a move clear through 115 and up higher, or below this 112 and lower. And I think ultimately that's going to have the strong impact on UUP, and that's going to have the strong impact on what we see on gold and silver. And so I think this is an important chart to watch, even if you're not a Forex trader. Now, yes, the U.S. dollar is moving up, but we'll see what happens now that it's below 113 once it hits 113. Now, if we look at the U.S. versus the Canadian, you can see that we this potential inverse head and shoulders that we pointed out last week, we're starting to lose the right shoulder, and we're starting to come right back down towards the neck. And I think at that point, that would invalidate this idea of a nice little bottoming pattern here off of this drop and a setup for a move to the upside. But at this point, there's still hope if it can find some support here. But this was a key drop through a critical level of 131 or so, 132, and this is, I would say, a sign that's bodes poorly for the U.S. dollar if it continues if it has to come down and test 130. However, the U.S. versus the yen is still strong, and it's just setting up a flag. So even with the selling pressure we've seen on the U.S. dollar over the last 2 or 3 days, it's still held up versus the yen. I think overall, the key here is that we're seeing a pretty mixed bag, and maybe we get more clarity after today's FOMC statement or FOMC minutes, and that gives us a better idea of what's going to happen next across the board. But for now, I think we need to wait and see. And I think once we see what happens with the U.S. dollar off of the FOMC statement, that'll give us a little bit more clarity on what's going to happen next through these crosses and gold and silver. And finally, we have oil, which is actually breaking out very strongly. This is a very critical breakout through 55, and I think means that oil wants to move its way back up. I think there's plenty of room of upside here. And if you are looking for potential trades to the long side, maybe find some oil names that are mimicking this pattern and are looking to move forward. Now, again, it just broke out today, so it's kind of hard to chase the action right now because we've had 1, 2, 3, 4, 5, 6, 7 green days in a row on CL, and there's a chance that it pulls back. But I think at this point, very similar to what we were mentioning on the NASDAQ and the Dow Jones and IWM, we've broken a critical level here, and as long as it stays above that level on the pullback, that becomes a really good area to go ahead and take a long play. And again, it's not necessarily you're going to trade oil futures, but you can look at names that benefit off of oil futures and oil prices and trade those to the long side. And that might be an area that works even if the markets start to stall out or behave in a weird manner in the coming weeks. Okay, so that's oil, gold, and silver. I think again a lot more bullish opportunities in this space right now, or at least there were in the last few days, than there were in the markets in general. Unfortunately, like I said, I missed that last gold rally, but I think that there's still potential for a new move once they sort of stabilize and set up again. And I think the key is, of course, to watch the U.S. dollar on that. Now, let's move on to the chart requests. James, like I said, you had one. Anyone else in here? We actually have a nice turnout today. So those of you that are here, whether you're new or one of the regulars, let me know if you have any questions. Also, Wes, that chart that you sent me, if you wanted to take a look at it again, let me know. Hopefully I gave you the information you were waiting for, but let me know if you had any other questions on it. All right, so interestingly enough, it's almost like the perfect segue, James, from oil names to Continental Resources, which is an oil and gas name to begin with. Now, my question for you is, are you looking to start a trade on this, or is this a name that you tried to take a shot on already? Very big volume spike here. I don't know if that was earnings. It probably was earnings, considering that's the news thing here. Now, this actually is interesting in that I want to point out something that I see on this that it's an interesting sort of way of looking at a chart. It's a way of giving you a good hint as to what's happening. You're in it. You sold a call spread. Okay. So you're sort of bearish on this, which leads me to the point I was actually going to make on this. Although I think that it might turn around just because of what oil's doing. But the point I wanted to make was, we were discussing with the stock market right now. We're looking at the S&P 500 and the NASDAQ, how it was moving up with momentum and trading off of bull flags and bear flags and whatnot, right? Well, this is the perfect example of when a bull flag turns into a base that ultimately is probably bearish. When you have a move, right? So, for instance, we got a strong move, right? Then you have a flag. Typically, you don't want these flags to get too long, right? Because that means that the momentum's shifting on it. So, typically, you want a short flag and then another move, right? Same thing. You want a relatively short consolidation range, and then you want the next move, and so on and so forth, right? Now, what happens when that move isn't so quick, right? It starts to drag out and drag out and drag out. Well, typically what happens in that case is you don't have enough momentum to push past that level. So the next thing is, if you can't push past the level in one direction, then you have to retest in the other direction, right? And it doesn't always mean that it's a top, but the longer that these bases get, the more likely that you need to retest lower before you can go ahead and push higher. And that's what's going on right now with CLR. Now, another problem with these is sometimes they drag on because there's a news event coming, whether it's earnings or something else, and that ultimately is the issue here. But you'll notice with CLR what happened was it started to drag on, and then eventually it broke down, right? And I'll zoom in for you to get a better view. Eventually, it tried to really set up for a move, and it broke. And then you ended up getting this. You ended up getting a move back up, a retest, and a failure, right? So you had a bull flag that failed. Then you had a second try of breaking that and failed. And then we lost that level, that little momentum that we had, that we built up. We came down, moved up, tested that level again. Notice it didn't even reach that level and failed. And now we've sort of broken down and come up and are at the point where we're going to have to retest this area again, which is this 45 area that it failed. So your call spread is actually a really good idea. Now, what I do want to point out is this thing has failed. You could say it failed here, right? And then it failed here, and then it failed here. And that's ultimately bearish, but at the same time, it didn't fail spectacularly, right? It just dropped a little bit and then keeps trying to go back up. So I think ultimately there's still enough buying support here that this will ultimately try to break 48. It's just not doing it in a quick manner, right? But it didn't actually lose. Even as soon as it lost this level, it had the big, strong move on volume and made its way back up. So I think the call spread's a good idea, but I think that this also is setting up for a spot where it will eventually probably try to turn and break out above 48 and move to the upside. But I don't think it's going to catch you by surprise because, again, it just had news. It just had big volume, and it didn't really move past that level. And I think it's going to climb right back up, and then probably what it's going to do next is it's probably going to have to start changing these trend lines to the point where instead of going down like this, we're going to start getting them to kind of go like this again. And then ultimately it'll try to break out and move past this level. So it's still struggling. I'm going to clear out all these trend lines. They're not really that important right now other than the one big one. Wow, these trend lines are really dodging me today. All right, so I think for now this is the key price area. I'm assuming your call spread's somewhere in that area, and that's really all we need to watch right now is what happens around 48. Once it breaks 48, then we'll see whether it has the momentum to push past there, and then it can make its way up to maybe the 50s or 52, 53. But I think for now, what you're doing is fine. And I think that this is a key level that it's really struggling with. But I do think it will break it eventually, especially if oil keeps kind of climbing higher. Then a lot of these names are going to follow suit and are going to try to kind of play catch up and benefit off of that and move higher. So that's what I see out of it right now. But I do think that this is going to be an area it needs to push past, and I think it's going to still need. I think it still needs at least one more attempt at it, maybe two, before it can sort of get through this. Now, I do want to point out the one thing I was saying about how a flag turns into a base. That doesn't always mean that it's going to be a reversal. That's one of the key things to point out is that a lot of times every base comes from a flag that got too long, right? And not every base is a reversal. Sometimes you get a base that turns out to just be a continuation pattern. But I did want to point out that once you see momentum starting to wane like that and you see these bull flags getting longer and longer, it gives you a pretty good hint that more likely than not it needs to test in the other direction first before it could eventually try to push past those levels. Okay? Ron, you wanted to ask about U.S. silica, right? Okay, so this is a nice push. All right, so let's take a look at what it's doing in the long term first, right? And you know, it looks pretty bullish in the short term, but if we look at it longer term, it's got a lot of work to do, right? So I'm going to point out a few. Now, this 24 is irrelevant at the moment, but this ultimately shows where this ultimately shows there is a lot of potential upside on this play. But that's a longer term play, right? All right, so if we go back to the daily, we get an idea of what's going on here. We've got this gap that it just broke. That's actually pretty bullish. You'll notice when we broke down from 24, it sort of trickled down. We had some nice attempt at a base here around 19, 20 bucks, and it failed. And then when it got here, it gapped down, and it really tried to stabilize here, and it failed. So we had another key area of support, and it failed there. And then we printed this nice little sort of cup and handle, tested night 12 or 13 again, and they kind of came up. And we're in the process right now of breaking past this level, but I don't think that this is a good buy at the moment, despite what we're seeing here. And the reason I say that is because we look at what we've done the last 4 or 5 days, and we've gone from 1270 to 1580, right? So 3 points in a span of 1, 2, 3, 4, 5, 6, 7 days, right? Only one slightly red day. I think at this point, if you buy it, you're buying into what's probably going to be a consolidation range. Now, that being said, I do think that this is a very nice breakout, right? And I think that this is a really important, critical breakout. But what I'd like to see here is I'd like to see us retest and then break out again. And then I think that makes for a really good move up to 18, and then, I mean, maybe even 24, although I don't think it gets to 24 quickly. But I think it could get to 18. I think there's 3 more points of upside here. The problem is we've got 3 points of upside, and really we've got 3 points of downside. So that's the reason I say I wouldn't buy right now, is if you bought right now, where do you stop out, right? You have to stop out like way down here around, I mean, at the very least, you have to stop out here around 14. And even then, that's sort of an arbitrary stop, because if it goes down to 14, it could still be healthy and still has a nice room, one more point of pullback before it really hits support, right? So I think what we want to see right now is we want to see a new support area form here where we could say definitively that it won't break, say, 15, right? So maybe we get 2 more hammer candles around 15, and then once it starts to clear, then we could say, well, we could put our stop at 15 and know that we're fine here, because if it comes back and retests 15, then there's a good chance it retests all the way down to 13. So that is what I would say. Now, so your question also was, you're in it? Oh, you're already in it. Okay, sorry. So I was misjudging what you asked. It's okay. So your question, is it a reverse head and shoulders, and is it above resistance? Okay, so I kind of answered one of the questions already. It's above resistance. I'm just hoping it stays above. So not sure when you got in. Hopefully you got in on this big green candle, in which case you ended up getting good risk reward, or a decent risk reward, but at least you got the momentum. Is it an inverse head and shoulders? I think it's not an inverse head and shoulders, but at the same time, I think it's sort of the equivalent of an inverse head and shoulders. And the reason for that is we had a push down to a level, and we tried to break past 15. Then we had a push below that level. Then we tried to, notice we didn't get all the way back to 15. We just got to the middle of the level, right? But we tried to push past below 13 again, or 1280, and failed, and made a move past it. So I think it has certain elements that are analogous to an inverse head and shoulders, but I don't think it's actually an inverse head and shoulders. But I don't think it's necessarily important that it's that it has to sort of match the textbook definition of a head and shoulders. I think it has a lot of the same components, which ultimately mean that this is a pretty good bottoming pattern, right? And so I think I like this play, and I think it's good to the long side. I don't think it's a good entry now, but if you got in before, then you're better off. You said, so thanks, you'll use a tight trailing stop. I don't even think I don't know what your entry is, but your stop doesn't have to be that tight. You just have to give it, I mean, there's a chance that it's going to trade in this little white area and then continue to move upwards. So it depends on your entry. If you had an entry somewhere in this area, then yeah, you probably want to keep a tight stop. But if your entry was down here in the $13 area, then I think you have plenty of room for error before, because it'll probably shift around in here, but ultimately it should head higher. And I think there's room again up to 18 at the least here. And I'm going to bring this up. Someone had asked for this one, Intel. I can't remember who it was. It was maybe 3 weeks ago, and they were long on the play, and they were asking whether they should take profits or what they should do. And it was right here that they were asking, right? And I mentioned 2 things. I said, yes, you should take partial profits because of how far it's moved up, even though I think ultimately it's a very bullish sign that it broke a very critical range, right? And as you can see, if they didn't take profits, there was a chance that they would have gotten shaken out, because it came all the way back into this base before it ultimately moves higher, right? And I'm seeing something pretty similar with SLCA in that I think ultimately the breakout is real, and I think that this is a nice move, but there's a chance that it has to backtrack in here, and that's why I was saying it was a bad idea to try to get long. Oh, it was you, Wes. Great. So you were up 5, you stayed in, got 7%, and you're out now. Okay, so awesome. So this, I think, ultimately is doing something very similar, which is that it's establishing a nice breakout above it. But I think that sometimes these breaks take a little bit more time. Now, that being said, this one hasn't formed tweezers like Intel. Intel was showing like it was starting to get tired before it was really ready to move on. This one hasn't shown yet, other than a hammer. And again, you don't want to hammer at the top of a range because that does show that there is some selling pressure coming in. But I think this was still fine. It just, as far as where it's going now, it probably needs to stall out for a few days. So I think the issue is where you got in and what you're doing. So you have June, so you got June 15 calls. So as far as that's concerned, you have time. But again, it depends where you got in. If you got in earlier today, or if you got in late yesterday, well then yeah, you don't want this to backtrack because then you might get sort of shaken out on it. But if you got in earlier and you have a good price on it, then I mean you can give this a little bit of time and a little bit of room because I think there's still plenty of upside, and I think it did a very constructive thing breaking out of this range, and I think ultimately as long as it doesn't violate this ascending trend line, it's probably in good shape. And even if it does, I think it might still be okay as long as it doesn't fall below that gap. But if falling below that gap puts you at a loss, then maybe you want to protect yourself a little bit more than that. Okay. All right, so that covers it for today. I think I got everything. If you guys have any questions or if you ever have any chart requests, you can always ask me on Twitter. You can always email me like Wes did. I'm more than happy to help out whenever I can. Or you can find me on Discord and ask me on there. Like I said before, let's see what happens with FOMC, not just today. Let's see how we close today and how we open tomorrow. And I think that'll give us a better idea or a better gauge as to where the market wants to go next. I'm honestly hoping that we drop. Not significantly, but enough to sort of reset a lot of charts and to give us better risk reward. And give us some nice new buying opportunities. Other than that, hope you guys have a good rest of this week, and we will meet again on Wednesday. Thank you, Ron. I am nice and warm. I'm not freezing like the rest of the country or rest of North America is. But sometimes I miss winter. But we'll see. I'm going to go skiing next month, so I'll get some cold weather then. But yeah, so that covers it for today. I thank you guys again. Those of you that participated, those of you that attended, I always appreciate I always appreciate when you guys show up and when you actually have charts to look at. But we'll see each other again next Wednesday. Okay, guys?